So you also you have written a piece about why this Bitcoin cycle is differently. You compared a lot of what's going on right now to past market cycles, both the bull and bear market. So explain why you think this cycle specifically is different.
Yeah, sure. So when you look at the early days of Bitcoin, it was really kind of driven by cypherpunks and people that were savvy with cryptography. And then in 2013, you had Mt. Gox and the aftermath of the compromise of that exchange. And then in 2017, it was really retail driven. And you can kind of see that on chain where coins on exchanges was steadily going up with price throughout that time. And then in this recent cycle, what really differentiates it for me is the fact that coins are being pulled off exchanges. And you can see that on chain by looking at kind of this dramatic slope downwards. And I think that's driven by a couple things. The first thing is that people are just understanding more of the importance of cold storage and taking custody of your coins, especially institutions that are piling in huge sums of money and they're not going to play around with having this counterparty risk. And the other thing as well is that miners have completely stopped selling, and you can see that on chain as well. They've actually started accumulating. Even Marathon, who I think a lot of people are familiar with, they've come out publicly and said that they've started accumulating. And the third driver, I think, of the coins being pulled off exchanges is this concept that's been made popularized by Preston Pysh and Plan B. And that's this whole concept of over collateralization and people taking advantage of arbitrage spreads through the difference between spot price and the futures price that's trading at a premium. So right now, I don't have it in front of me, but if you look at the futures price, it's trading at a multi-$1,000 premium to the current price. And it's interesting because commodities traditionally trade at premiums, but it's because they have storage costs, for example, like with oil. But Bitcoin has no storage cost because it's digital. And so to kind of just speculate, there's no way to know for sure, but it possibly is because there's regulatory restrictions that aren't allowing certain institutions to get exposure to spot Bitcoin, and they may be doing that through the futures market. The other thing as well is that it's really easy to get leverage through the futures market. So those are the two reasons that I think, whether it's one or the other or a combination of the two, that's driving this premium in the futures price. And so people are looking to capture these arbitrage spreads on an annualized basis. On an annualized basis, they're trading at like 14-15% right now. And when they go to capture these spreads, they have to lock up these coins because they have to borrow the coins from a lender such as BlockFi. And BlockFi requires like the loans are collateralized with a 50% LTV, which means if I'm borrowing $50 worth of Bitcoin, I have to post $100 of collateral. And then BlockFi takes that $100 and then they transfer it into Bitcoin to kind of eliminate some of the counterparty risk for the person on the other end that's lending their coins out to who's borrowing them. And they turn the collateral into Bitcoin to be held in escrow until the borrower is able to pay off the loan. And so what this is essentially doing is it's locking up more coins out of supply than would have naturally taken place through the natural supply halving, if you will. And I think those three factors between people just flat out understanding cold storage and having an importance on that, miners stop selling, and then that over collateralization to capture those arbitrage spreads. I think those three things are really what's driving that the supply that's being pulled off of exchanges.